Hey, everybody, welcome. Thank you all for joining me here. So we are just about to jump into how to prepare for a home purchase in a cooling market. So I just want to first jump into exactly what is home, because I think that's the big driver of real estate purchases here in New York City. I don't want to lose sight of that idea. It's a place where you're comfortable. It's a place where you spend time with your partner. And increasingly today, it's become a place where we work, where we share, where we're comfortable. So I think understanding and being able to connect with that during your investment journey, either as a home purchaser or as an investor, is super crucial. So, question every real estate agent is going to get is, how's the market? And we are obviously coming out of an extraordinary housing market in the past couple of years, especially nationally. So just stepping into that national sphere, it's just been an absolutely insane market, from markets including Massachusetts or Vermont, Austin. So just looking at all of these markets around the country, housing has been absolutely bonkers. And a lot of that has been driven by all the stimulus money that's been printed from, by the Fed, but also just the really low mortgage rates and just that fusion of office and home. So everyone's been in the market for more space. And just stepping outside of our New York bubble, I'm looking at Austin as an example, where you just have consistent double-digit growth, or the Portland market, which reflects something quite similar. But then you step back into the narrative around New York City, and there was a period of time, and I was actually in New York through all of COVID, and this was certainly quite dramatic. I've experienced the empty Grand Central, and I think, if anything, it speaks to the resilience in the Manhattan market. It speaks to the resilience of the interest in New York City, that even through this really tough time, people still returned. And this is something that certainly it has precedent in its own way. Back in the 70s, during the fiscal deficits, Gerald Ford refusing to bail out New York, and you could just see how much the city has thrived and grown ever since then. And then just looking here at 2021, it started becoming clear that people still had a long-term interest in living and working in Manhattan. So what we saw was just stunning growth in terms of deals and trades and transaction volume. And just stepping back and answering that question of how the New York City market is, I'd like to just highlight a few different areas. We are still actually below peak pricing back in 2016, which I highlighted in the first circle. 2019 was where some high price deals were transacted in response to changing tax policy. And then you see through 2020 that dip in pricing as a result of COVID, where I saw a lot of deals happening at about a 8 to 15% discount, depending on the product. And now through 2021 and entering 2022, well, deeper into 2022, you see that the market has largely returned to pre-COVID levels. So while the discounting that was available during that period of peak 2020 is no longer, I still actually see value relative to 5 or 6 years ago. So what exactly does that mean? What am I talking about when we're talking about value? Here's just one example. On the Upper East Side, a 2-bed, 2-bath. And back in 2015, it actually sold for $1.9 million. And you can see today, it's currently listed for $1.7 million. So through COVID and everything, you're actually still able to get a discount on a home that you might like. This is also reflected in another apartment here on the Upper East. And this actually mimics the entirety of the whole market. So 2017, it sold for over 2.2 million. Then there was a COVID trade, which was substantially discounted for 1.5. And now it has been relisted with the price steadily declining to 177, but still substantially discounted from when it traded back in 2017 in a better market. Okay, last example here is just one from Battery Park. You got a sale back in 2017 for 860,000, and it's currently listed for 710. So definitely some opportunities if you step back and look a step beyond the asking price and actually look at the historical trades that are happening in these buildings. I think it's important as a buyer to not just pay attention to your discount from the asking price, but also controlling for the last several years, assuming no renovations or a consistent product, and stepping back and comparing that to several years ago. So there's a number of examples like this which exist in our market. And I think the most interesting part about it is the recorded sales you're looking at don't actually account for inflation from that time. So if anything, that shows an even steeper discount when you add in the cumulative price increases from that period. All right, and you're probably asking yourself, and what's probably a very logical question is, why would I invest in an asset that is clearly depreciating? And I think there's a lot of different policy reasoning that actually happened. So I like to think of the last several years as a policy reset, and that includes items like the SALT taxes, which I'll get into, changes in the mortgage interest deductions, our mansion taxes have evolved, and at the time there was an oversupply of new development, which has started to erode and be absorbed. So the big premise here behind the policy reset, we're talking about the SALT limits, state and local tax deductions, which you can deduct from your federal tax return. So it used to be an absolutely unlimited deduction that was possible ahead of President Donald Trump's tax overhaul. And that was later confined to a $10,000 cap. So that really impacted high cost states and high tax states like New York and California. And I think what's important to keep in mind on this is it is a political football right now. So this is actually expiring in 2025. The Democrats did bring forth expanding this tax deduction to $80,000 in their last budget bill. And it wasn't passed by the Senate. So we'll see. This is something that's constantly evolving, but it did reflect some of the price decreases that we saw over the last couple of years. Okay, another, but perhaps slightly less significant one was the mortgage interest deduction changes. It used to be a limit of $1 million, and that was cut back to $750,000. So that too impacts folks who are borrowing a larger amount of money, which is more typical of our coastal states. And then there was also the mansion tax changes. And previously, this used to be 1% for purchases above $1 million. So that was whether you're buying a $50 million apartment or a $1.5 million apartment, you would have a 1% charge. And now it bumps up incrementally as you go into a higher price point. And I'll just say, I'm starting to see the Q&A come in a little bit, so feel free to leave any questions and I'll try to answer those as we talk through some of these slides. All right, and now just entering the current day market and thinking about that angle, I highlighted a couple different areas on this slide. One was that reduction in supply during COVID, which you could see. And then all through 2020, the supply just kept on growing and growing, which accounted for all the discounting that you were seeing. Through 2021, you could see that starts to decline. And that was when our market really was catching fire, especially given the 3.5% mortgage rate environment. And now we're starting to enter this phase, which is our last circle, where we're seeing supply start to rise. We're seeing a lot of buyers hit the pause button while they step back and give some further thought about what their plans are. They're seeing their stock market portfolios decline. And that's causing a bit of a pullback in the market, which I think represents opportunities for buyers right now. Looking just at the market pulse, you could see how deep it went into that buyer's market through 2020. And then we started entering a seller's market through 2021. We're still technically in one. All of this data looks back a couple months. So I believe we're starting to enter that neutral market and pretty soon a buyer's market. So just want to be mindful of where we are, and compliments to Urban Digs for providing some of this data. Okay, another area that I'm paying attention to is just the net deal volume against the historical average, that average being 0, which I think you get a good picture of that in, say, 2017. You could see through 2020, it was really low, which represented opportunities for buyers. Now the deal volume's a lot higher, and it feels like we're starting to get back to that historical average. So with that, I think that there's some opportunities for buyers in this market. So how should you think about this? The mortgage rates are rising. For one, I really want to just step back and look historically and just understand what the historical context of mortgage rates are. And we're way at the end of this chart. Right now, the rates are between or hovering around 5.5%. And you can see that obviously there was an increase from late 2020 and through 2021, but relative to the 1980s or 1990s, we're still sort of in a low mortgage rate environment. So I think taking a step back and just looking at this historical context, even the market leading up to the 2008 crash was also a higher mortgage rate environment, more reflective of today than where we were just several months ago. And then another area, especially for my primary homeowners, is thinking about that renting versus buying equation. So median rents in New York right now are actually at an all-time high. And I think it's interesting to look at some of these real world examples. Just pulling up a classic TikTok video that's showing the lines at these open houses to come into a rental apartment. Just people crowded outside to get their hands on a rental. You got the real estate agent in the back there directing people to wait across the street. So it's a bit of a bloodbath in terms of finding a rental in New York City. So much so that they created a term called cuck money, which is where you offer to pay a higher monthly rent than what's even being asked in order to secure an apartment. So, we're talking about, in this instance, a $3,600 rental, but offering an extra $400 of cuck money in order to secure that apartment. So I think that this reflects how between your mortgage and maintenance on a condo or co-op against what you would be paying in rent, I actually feel like that gap is starting to shrink. And this is just your overall footprint of where rents are. And you can see they're really have been taking off, and now they're at all-time highs. I will be sending the slides, everybody. So feel free to just send me an email. And I think I have a few points of contact for some of you. So we'll make sure that we get the slides out to you. So just taking a look at the rent versus buy equation, we've got a rental here. Let me just step back a moment. So this is an apartment for purchase on the Upper East Side. Asking price is $1.49 million for a 2-bed, 2-bath condo. And I want to look at this side by side with what a similar apartment costs to rent in New York City And we want to put in all the numbers, the variables of the taxes, the common charges, what your mortgage looks like, and compare that to what the rent prices look like and where you start to break even when you buy a home. So here's an example of a similar apartment that rented 4 months ago for $6,800 a month, also a 2-bed, 2-bath. Maybe today this apartment might rent for slightly more because the rents are increasing by the month. So just looking at that side-by-side basis, it looks like you break even at around 5 years. And I'm going to actually show you another slide that shows where that number can cross at 7 years, because some of these factors are dependent on the type of mortgage you obtain or what your returns on your cash might look like in the stock market. So taking a side-by-side approach to give you an aggressive and conservative estimate, I think, is appropriate here. So this, of course, on the longer time horizon may reflect for a higher return in the stock market or in other areas where you might not be putting so much money aside towards your home purchase. And then I just want to give big picture for anyone considering buying, what the closing costs look like on this type of apartment. It's about $55,000. That will fluctuate based on how much you're financing. The mortgage recording tax is the bigger one there that will add or subtract to your costs. And the mortgage recording tax actually for co-ops isn't even existent. So that's only for real property, whether you're buying a townhouse or a condo, it does not actually apply to co-ops. So the entry point for co-ops in terms of affordability is really nice. So how am I advising my buyers? I want them to make the market within reason. I think there's a few different areas to think about. One, the smaller apartments right now, where that threshold of that mortgage payment can impact whether or not someone moves ahead, I think is reducing some demand in that area. I want everyone just to be mindful of the numbers that we are still below that 2016, 2017 peak. And then what I think is interesting for folks financing versus those who aren't, in our market, a lot of listings actually sell to all cash buyers. So that does limit just how much the prices wobble within New York City. I think that's why we've seen that historical stability over the last several years, is because there really is that deep pool of buyers potentially from around the world who aren't as impacted by the mortgage rates. And just thinking about this in terms of how you want to take next steps, I think being slightly agnostic around exactly what apartment you want is important. I think you will get a little further ahead in pricing, because just stepping back, I think about buying an apartment between the financing component, which is everyone wants a great deal, but then also more of that homey artistic sensibility, which is this is a place I want to live and make my own and make my home. So I think if you do have some flexibility around that latter piece and you're willing to submit a couple offers and find, who feels a little bit more motivated or who may not just pull their listing off the market and rent it, that will help you get a better deal in this market. Also, there are other financing options. I think it's definitely worth having a conversation with your financial advisor. I do see some folks borrow money against their portfolios at lower rates than our existing mortgage rate. So consider that an option as well. And then I'm also seeing a lot of opportunity in our non-renovated market. So this is great for, someone that's a real do-it-yourselfer, or TikToker looking for a dream where they could just film unlimited content renovating their space. If you're looking at non-renovated apartments, there's definitely a fear amongst buyers right now about buying that non-renovated home because of supply chain issues. But I think if you have some flexibility going into the renovation, maybe you won't get that exact appliance you want, but I think you could still make a great home that's your own and do it within a reasonable timeline. All right, and now just stepping back as just a reminder of where our benefits are, just of real estate ownership generally. You're building equity. You will have capital gains exemptions when you go to sell. You still do have that tax deduction. And real estate acts as a hedge against inflation. So we'll get into that a little bit further. And then, of course, the potential for upside. So I think, for my clients who are looking at the discounting that exists out there, that opportunity to buy and see some appreciation moving forward is a great driver. All right, and now just talking about owning in Manhattan. I think looking at that broader trend and that chart we pulled up earlier definitely tells that story, that even with all of these new changes in tax policy, you didn't see the market set back that much. I think most buyers are able to retain their equity over the long term. I think when you're looking at these types of investments, you want to have that longer term horizon, whether that's 5 or 10 years where you could see that appreciation. But looking at New York City and Manhattan in particular, obviously you're supply constrained. So you have bodies of water literally around the island here. You have heavily landmarked districts where you can't build anymore. And then you just have a thriving job market here. So office occupancy now has crossed 40%, which has been a long time coming, but I do find that a lot of commercial tenants are now starting to call back their employees to come back into the office. I do think that that's going to be a driver of why people are, certainly in the rental market, why people are coming back and why that rental market is thriving so well. And that rental market is also a product of our academia that's here, NYU, Columbia. There's just so many brilliant first-class institutions that are based here that people are constantly moving to. And I want to think about all of this in the context to, let's say, a small town in North Carolina that's dependent on a military base. And if that military base closes, that shrinks the entire job pool and reason for people being there. I think that there's just this constant reminder all throughout the media, whether it's Friends or Seinfeld, that has New York City certainly in mind for people around the world, which makes it a destination for people to come to. So I think all of that anchors people's investment here. And then just thinking about real estate as a hedge against inflation, right? The rents are going through the roof, housing costs are going up. You'll be able to have more control over that over the long term. Okay, there is, for a while, Bitcoin and cryptocurrency was looked at as a place to store wealth over the long term, but you see that there's very large fluctuations there. And the peel back in the stock market, I think, also gives some indicators of that. But real estate doesn't operate in tandem with cryptocurrency or stocks. Maybe there could be a very slight correlation, but on the whole, I think you would see that your investment will be secure and it's a good place to park money. And then just also keeping in mind that your borrowed funds are in today's dollars. So if you borrowed $1 million today towards your home purchase or $500,000, you're borrowing that today. So as inflation picks up, the value of what you've borrowed is going to feel smaller in the long term. Okay, just another area to think about, especially for those in the high net worth categories. Real estate obviously diversifies your portfolio. You do need a place to live, but keeping real estate as one portion of the equities and whatever else you might own is certainly recommended by most financial planners. And now just, thinking about courses of action, how you can get in the game, so to speak, what steps you need to take and what you should be prepared for in this coming market. For one, I think everyone's got to take a closer look at their qualifications For co-ops especially, I usually see a 25% debt to income ratio being expected. And what does that mean? That means if you have, say, $5,000 in housing costs, which would represent your mortgage and maintenance, the expectation is you would be making around $20,000 a month in income. So that would be that gold standard. There could be some leeway upwards. Some actually may expect you not to be financing at all, but that should be typical of most co-ops in the city. Why do we look at co-ops and not condos? Usually they are a bit more affordable because they speak more to the primary homeowner rather than condos, which speak to not only primary homeowners, but investors from around the world. And just another area to consider around the co-ops is the post-closing liquidity requirements, which could be 2 years, it could be more. But if we're talking about that $5,000 a month mortgage and maintenance payment, they'd be expecting you to have about $120,000 in post-closing liquidity. Sometimes that could be obtained by a gift or some other means. So that is something else to consider when you're weighing out your qualifications. And I think it's also just important to think about your qualifications relative to what a bank will lend you, because at least for co-ops, they are usually more stringent in terms of the financial requirements. That way they could prevent arrears from happening or having to pick up the maintenance payments of your fellow shareholders. All right, and then just thinking about your team, your real estate agent, here we are. You would want an attorney, which I've spoken to a number of my clients from outside New York. They're often surprised to find out they need an attorney. You do, it could be anywhere from $2,500 to $4,000, depending on who you're using. You want your mortgage lender in place. I usually recommend at least talking to 2 or 3, and I usually recommend talking to folks at larger banks. Wells Fargo lends a lot in New York City. I recommend Bank of America is another strong one. And I recommend that instead of, say, Rocket Loans, because Rocket Loans, which might issue a loan out in Minnesota, does not necessarily know how to underwrite a co-op or a condo. There is a lot of due diligence that they have to take in order to process your loan. And they're very familiar with that. And not only are they familiar with it, but in a lot of instances, they already have the due diligence and the relationships available in order to connect those dots. So they might already have the financials on the building to be able to underwrite it, or they might have already done the due diligence. So working with larger lenders that actually operate within New York City is super important. Your inspector, I know some agents don't recommend inspections for their apartments because the larger items like the roof or the boiler are usually shared by the entire apartment complex. But I like getting the inspector in there just to test AC units. You usually find out that the lifespan of certain appliances is starting to reach its expiration. I think in a cooler market like in 2020 and 2021, we were able to knock a few dollars off of the price when we found certain items that weren't in working order, which is the phrase that's used in the contract that all appliances need to actually work. So sometimes that's available. I think more recently, I was discouraging clients from pursuing that too aggressively because it really was a seller's market. But I think at a minimum, you have your inspector go and make sure everything's good. And at least you have a blueprint for what needs to be upgraded in time. And then if you are really leaning into that renovation, having a general contractor who's qualified and responsive, or a lead architect on the project is super important. That way you could just shoot a floor plan over, get some preliminary estimates on what that'll cost. And then just thinking about submitting an offer, which is also a little bit different in New York relative to other places. You do need your pre-approval letter from your bank, but you also want to have what's called a revenue financial statement available. And that's on this page here. And that outlines all of your assets, all of your liabilities. Sellers and their brokers usually won't look at an offer, especially for co-ops and usually condos too, unless one of these is completed. So super, super important and valuable to get ahead of this. And also, even before you start talking to a mortgage banker, it's good to submit this to your broker. And that way we could look at some of the higher thresholds for a co-op and tell you, we should be going this direction. We should be looking at co-ops that allow gifting in order to pad your post-closing liquidity. We can give you recommendations earlier in the process when you just start your search, right? Because you could be looking for 3 months or a year. We work with people over the long term, but getting ahead of this and sharing some of this information with your broker can allow you to put those steps in place so that you're not getting to finally submitting an offer and you realize that you've been shopping for too expensive of a home. Your offer form, of course, which would help you prepare. And then usually for co-ops and condos in the city, a brief biography is super helpful just to give some color. Co-ops, while they do have that veil with the interview board process, you want to try and preempt that a little bit. So, certainly, like I give an example, like Madonna was turned away from a number of different co-ops. And why was that? These prestigious co-ops, she has the money. And I think the fact is they just didn't want a bunch of photographers standing outside of the building all day. So examples like that they could sort of vet out, just things that may not work ultimately, that may not pass a co-op board. I think that's also a crucial component to the process. All right, so just some takeaways. The market is getting slower. We are returning to our more regular seasonality. The mortgage rates are up, but I feel like historically they're actually still very reasonable. Rents still are reaching their all-time highs and continue to grow, especially with inflation. I feel like there's good opportunities right now, and real estate is a great hedge against inflation and a great way just to diversify your assets. So talking to me, talking to your team, starting to put those pieces together will definitely open more doors for clients and allow you to act on something when you're ready. So want to thank you guys so much for coming out here and spending some time, and definitely feel free to email me here. This is my number. Feel free to give me a ring as soon as this evening if you'd like. And I'm followable everywhere on social media, so don't hesitate to get in touch and ask any further questions. So thank you all so much for coming out, and have a great night.